Hello and welcome to the Cube Talk Show. My name is Joe Barbieri. I'm your host for this evening, and this is the Money Show. We talk about all aspects of money. Today we have two guests, Dalia Barsoum and Enza Venuto from Centum Streetwise Mortgages. And by the name, we'll be talking about mortgages and real estate. The official title is the Top 10 Financing Questions Real Estate Investors Ask. And so, how are you ladies today?
Great, Joe. Thank you very much for having us.
So I usually start with some background. So tell me about yourselves and what you do and how long you've been doing it.
Okay. Well, my name is Enza Venuto, as Joe introduced us, and I'm with Centum Streetwise Mortgages with my associate partner, Dalia Barsoum. We have over 48 years of industry experience. We're very exclusive. We're a small boutique. We take care of our clients' needs, and our majority of specialization is with real estate investors, self-employed individuals, people that are going through changes in their lives like divorce. And basically that's the area that we focus on. We're very high in writing articles in the Canadian Real Estate Magazine, and we're one of the top brokerages across Canada. Dalia?
Yeah, as Enza mentioned, also to add, Enza and I are both ex-bankers. We come from a banking environment with the mentality of financial planning, and we bring that to every client conversation in the mortgage world. Enza was with CIBC for 30 years. I was with BMO for 15 years, and we work, at the end of the day, our business is mortgages, but we provide very specialized advice and lending solutions to certain segments in the market. Self-employed, real estate investors, couples going through divorce and separation, and first-time home buyers.
So these are people who are not, as a banker would say, conventional, or they wouldn't fit the box of the qualified mortgage. Is that?
We actually do a lot of business with banks because as mortgage brokers, we deal with many lenders, including the banks and what we call are the B lenders and the private lenders. So we come across clients who fall in any of these three boxes. And some of our clients, actually large clientele of ours, are bank clients and what we call A clients. So not necessarily, yes, we do get a lot of business from clients who go to the bank and the bank says no, and then we're able to approve the deal, but we do deal with A clients who are, have been bank clients for years.
The beauty of our business is that we build a relationship with a lot of our clients, Joe, and the way our clients see us is they tell us the whole story. It's like going to a doctor or going to a specialized person. That specialized person understands your story, can be relating to your story and being able to put it. Typically, if you walk into a bank, there's a certain box that you have to be within that box. We are within the box, but we're also outside the box. So we also help you think outside the box. That allows us to position you and help you strategize your financial needs in a larger scale.
So, well, we're pretty much talking about it. Bankers versus, or brokers versus a bank. Well, you mentioned the segments that you specialize in. How do you do it differently than a bank would? Is there a different process, or do you just say?
Well, the process is basically understanding what a bank is and what a mortgage broker is, and just being able to define the two areas. A mortgage broker is a person that is who acts in between the lender and the client. We gather your information, we understand, we assess your situation, we help you put this into a proper perspective, and then we go out there and shop for you. So we have access to a lot of lenders, which comes from a lender from the typical top 5 banks to then our broker-friendly lenders. And what we do is we help you and tell you exactly how we can bring your deal to the lender specifically. So the difference is understanding what a mortgage broker does versus what a bank does. Did you know that almost 45% of Canadians are actually using mortgage brokers nowadays versus 10 years ago that there were only 15% using it? So a lot of the consumers, the Canadians, are getting more adjusted or getting adjusted to using a mortgage broker. Why use a mortgage broker? Because a mortgage broker is there for you. It's accredited. A mortgage broker has to be licensed. There's a lot of accreditation, a lot of education that has to be behind what a mortgage broker does versus what in the banks, right? So understanding the needs of a mortgage broker is very crucial. And guess what? We get paid by the lender. We do not charge a fee for our services if we take you to a bank, right? So this is where a Canadian has to understand is a broker is a trusted individual that is educated, that understands your needs, and all we do is focus on credit aspects of it.
And with respect to the process, Joe, like we said earlier, we realize working with clients that every client's situation is very unique. We cannot take everybody and put them in one box and say, show us the numbers, let's punch the numbers, and here is the rate that you qualify for. It basically boils down to understanding the client's situation. And to take it even further, we find very unique differences across the segments that we deal with. For example, real estate investors. A lot of the investors we deal with either want to start investing in real estate, their first property, or they already have several properties and they want to build a portfolio of real estate, either for wealth building or to generate cash flow, whatever their underlying reason is. And the process on how we go about talking to that clientele is very different than the process that we use to talk to a first-time home buyer. Because we need, with a real estate investor, to understand what their long-term view is and where they are today with their financial plan and how they're going to actually get there, so that both ends and I can help them on the back end from a financing point of view, structure their deals, and also form a foundation on which they can continue to build properties or acquire properties. First-time home buyers, very different talk. It's about educating the first-time home buyer on what's involved in buying a property. What are the closing costs? What are the upfront costs? What are the holding costs? What does home ownership mean? Couples going through divorce and separation, again, very different discovery process and very different story. Couples here are talking about either wanting to, one of them wanting to hold on to their current property, or both of them going on their own, either one acquiring, one renting. There are a lot of legalities involved where we have to engage other experts in the process, and therefore our process is very tailored to the niche that we're talking to.
And you're also talking about individuals that are small business owners, entrepreneurs that are a business for self, as we classify them. A lot of the banks are kind of steering away from the small business owners because of the guideline changes that have happened. So when you look at that, we as mortgage professionals help our clients understand how to position it, and for self-employed people, how to make it easier, because home ownership can become difficult in these times where the business for self strategy is starting to weave out, where we understand the strategies and we understand how to assist a small business owner to acquire a property, or we work with them and also help them with building their wealth.
So real estate investors, that's I guess that's more of the focus of, so I'll get into more of the details. Now, if somebody comes to you and says, I can't get any more money, what options do they have?
As a real estate investor? Well, what we find is, first of all, why can't you get more money as a real estate investor? There is a reason to why you're in that boat, and we call it hitting the financing wall.
Okay.
And when we sit down with a client and take a look at what brought them to this point, what we find is that either financing was not structured the right way. For example, some clients may have used more expensive vehicles to buy real estate compared to using more secured lower cost vehicles to buy real estate. What I mean by that is using non-secured lines versus secured lines of credit to buy, or using cash to buy. And when we run our ratios and calculate the numbers on an application for a lender, that client lending capacity becomes much lower than someone who has used cash to buy or have used secured lines of credit to buy. And very soon their lending capacity starts to get limited, and they would hit that wall. So it all depends on how have they acquired their properties so far, how financing was structured for the acquisition of these properties, and also if they cannot get financing, it could be because of a credit situation, it could be because their personal situation has changed. Maybe at some point they were employed, now they're self-employed, and they fall under different guidelines. So until we take a very detailed look at the income, the employment, the credit situation, and how financing has been structured across the property portfolio, we cannot pinpoint the reasons. But once we do so, we're able to say, okay, as a client, here is what you can do. Here are some alternative methods to structure your portfolio or financing to keep building wealth.
And because we also deal with a numerous numbers of lenders, like we said, you may hit a wall because you're working with your own bank, where with us you can also be working with our broker-friendly lenders. That doesn't necessarily mean you're going to be hit with a higher interest rate. It's just that there's different processes in place. So the definition of hitting a wall, it could be that you could be hitting a wall with your bank because of your bank, the way you're positioning. But when you're working with us as mortgage consultants, advisors, we definitely have a different array of different lenders that we can work with that will allow you to be able to work with different properties and not hit that wall.
So this is about more options, isn't it?
Mm-hmm. Yeah, it's all
Compared
about
to-
options. That's right.
Now, so on that same theme, the self-employed person, I'm assuming this is the same story, but there's different variables to look at.
That's right.
That's right.
That's right. That's right.
With respect to self-employed, it boils down to how the income is reported, how long have they been in the business. There are several factors that play into, at the end of the day, how much the lender is willing to lend them
Mm-hmm.
and what rates are they going to see.
So we look at a self-employed. I'll give you an example. We have a self-employed person that just became self-employed a year. The mandate in any bank is that you have to be self-employed for 2 years or more in order for you to fall under that self-employed. So with us, what we do is we work with individuals and say, okay, you are now self-employed. What was your past employment? Same line of work? You have track record of the same line of work that you did 3-4 years, and now you became self-employed. We position you differently to make sure that the lender understands that, hey, Mr. Smith has been working for this company for 5 years. Now he's become self-employed, and Mr. Smith has this track record, which makes it much simpler in the future to get borrowing potential.
So are people looked at more like a business? So let's say I've been self-employed for 10 years in this business and I make X per year, and I can chart it on a chart and you can see the trend versus the first year. There's no history and you're just starting out. Or if there's a hybrid where you worked and then you went on your own, but there's a kind of continuity, that's all factored in.
That's all of the
So-
above, Joe.
Yeah.
All
Yeah.
the above.
Yeah, all of the above.
Because that's not something I've heard
No,
very
it's all of
often
the
talked
above.
about.
Yeah.
But as a business, that's what
Yeah.
happens all the time.
In the past, small business has been more lenient. Small business, you could just put a number. Now we're looking at a lot of tools and a lot of researches. You can go on the websites and you can check out with, let's say, CMHC or Genworth, the norms of the industry. So, for example, a person like yourself that is a consultant, a financial advisor, we look at the norm that you could be making. So you can't say you're making let's say you can't say you're making 200,000. But the norm in your industry could be 100, 110. So we will use that norm. But also we look at what your gross business income was or what your past income was. And that gives us an indicator of how, it's like in any investment, it's past performance to future performance, right?
Yeah.
And there are two ways typically with a self-employed client. There is what's called a stated income product and actual or conventional lending. And under conventional lending, we would go with whatever the client reported on their notice of assessment in terms of income. But if someone has, let's say, a corporation and the corporation reports a gross income, and then after they upload the expenses, the net is significantly lower, and then they pay themselves even a lower amount at the personal level, then we know that in their line of business, they do this much money, although at the personal level, they're reporting a much smaller amount. That's a product called stated income product, but that's where the norms kick in. That's where we look at the notice of assessment and T1 general and look at the gross business income and factor that into the overall equation.
So it's more like how much do you actually make
Yeah.
from everywhere, as opposed to here's a line item, and if it's not there,
Exactly.
too bad.
Because the small business industry has been looked at differently, where they think a small business person will have the likelihood of losing their home more than a person that's employed, which we personally don't.
I actually think it's the opposite
It's
now.
the
I think
opposite,
it's
that's
all-
right, Joe. It is
Or
totally the
It's at
opposite.
the very least even.
A self-employed person has more responsibility and has more, if you look at the default ratio, it's not on the self-employed person. It's more on the consumer or person losing their job because of downsizing companies and letting people go because of that. A self-employed person is more geared to strengthening themselves and positioning themselves in the future.
Yeah, I've always thought it, but I've never seen the statistics, so
Yeah,
maybe
yeah.
now we'll start to see
Now it's a
them.
good time to really review that, and a
Yeah.
lot of people are really moving towards the consulting, self-employed structure.
So now, what about the interest rate? Everybody talks about the interest rate and getting the lowest interest rate. How do you approach that with somebody? Because now there's more variables
Mhm.
and there's more options. Do you, I guess you try to find the best rate, or is it how?
Well, as part of what we do, we have more options, like Anza mentioned, and we want to get the client the best rate. But the best rate statement should not be used out of context, because it's the best rate for that particular client. It's based on their situation. It's based on the lending guidelines that fit their situation. So let's say there's a marketing campaign out there that says the best 5-year rate right now is 2.89 or 2.99. We get calls from clients who say, okay, I want the 299 or I want the 289. It all boils down to qualification, and if that client will be approved for such a rate. And it all depends on 3 things: their credit, their employment, okay, and their income. And are they going to fall within the guidelines of that lender that is offering that particular rate? So
Yeah.
that's one thing. Qualification is one thing.
Mhm. And we talk about too is that right now with the changes, and we always keep reverting back to the changes in guidelines because that's very crucial. Even though a client may call you and say, I want the 299 rate, that is not the rate that you're qualified on. The rate is based on the benchmark Canada, the Canada Mortgage and Housing benchmark, the bank benchmark. So right now the bank benchmark is 5.24. Even though there is a rate of 299, it doesn't necessarily mean that you may qualify at that 299, because that's what's called a teaser rate. And those teaser rates are not necessarily allowing you to qualify for it. So people, clients have to
That's the
understand.
extra best rate.
Yeah,
isn't
that's
it?
the best rate, but it's only to the best of the qualifying process. So with both Dahlia and I, when we get this question asked is, what is your best rate? We don't answer it to the rate. We answer it to, can we help you understand what you mean and how to position it so that it allows you to give you, we quote your rate, because quoting a rate, people always remember a rate, but it's being able to qualify for that rate that's very important.
And the other thing is, read the fine details,
Yeah.
the fine print, because it
lot
may
goes
be
into
great.
that
It may be
That's right.
great. It may be great to get the 299 rate, but what does the fine print say? Is it actually? Are you locking yourself in, and there is a very hefty penalty of getting out?
That's right.
Is this the right strategy for you? If you're a real estate investor who's buying a property and you want to flip this property in a year from now, and then you locked yourself into a 5-year 299, it's a fantastic rate. But guess what? When it's time to exit,
To pay
your
4 more
penalty is going to
years.
be extremely hefty.
Hi, yeah, exactly.
And some of these mortgages are completely closed. You can't get out. So it's very important for the client to read the fine details behind the rate and the cost associated with acquiring that rate. Because when you go seek financing, it's important to look holistically at everything from your prepayment options to your ability to pay that mortgage fast, to the savings on the mortgage, to your exit strategy, to the costs involved if there is a lender fee, if there is a broker fee, and then crunch the numbers and make a decision. Because there are times where a 3-point something rate is better than a 299 rate if you factor all of the things that we just talked about.
Exactly. And our approach to our investors and to our clients is, what is your strategy? Are you planning to hold it for 2 years, 3 years? Are you planning to flip? Are you planning to stay? A lot of clients, we also do some recommendations, and the recommendations are maybe a 2 or 3 year product that allows you to get the benefit of the lower rate and allows you to be able to exit strategy at that point. So it's all about us understanding your needs and knowing how to position your needs on how to exit your needs.
So just an aside, the guidelines you mentioned, is there somewhere somebody can look that up if they want to know, or if you could just do a brief?
Well,
I mean, I think I know some of it myself, but that they've made it harder to get a loan, and they've shortened the amortization time. And
there are some general guidelines out there, and
they're not engraved in
they're
stone.
just general, but every lender has their own
specific.
guidelines.
Yeah.
And these guidelines change on a regular basis, so it's important to speak with someone who's in the business and keeping an eye on what's happening in the industry and on the lender side.
We also encourage you to visit any of the websites, which is the Canadian Mortgage, CMHC. Also visit the Bank of Canada websites, or also you can visit our website too, that we provide you some insights of what's happening. But a lot of these guidelines that took into effect in December were shortening of amortization, qualifying based on benchmarks, business for self, different in different individual things. You can definitely, we encourage you to visit, but it's also important, Joe, that you do speak to a person that is educated in this area that can walk you through it. It's like the walk of life, right? You want to walk these people through. We want to walk our clients through so that we're not misleading them and we're giving them the right sound advice.
Okay, I think we talked about this, the person who's declined. I guess maybe you could just go through a couple of examples of that, about what the options are. I mean, you've talked about it in general, but is there anything that stands out where someone didn't expect to have an option, but they, in fact, that they did after they spoke to you, and they said, oh, okay, well, because I thought I couldn't borrow anymore because
We
whatever.
actually have a very fresh example from a client that we just helped this past week. The client has actually a very good relationship with her bank, and she's been to the bank and she was declined. And she's self-employed, and her husband is also self-employed, and they wanted to buy their first home. They're not real estate investors, they wanted to buy their first home. And they came to us, and we're able to approve them and get them to buy this property with a 5% down, which is doable right now for first-time home buyers at 25 years amortization.
Okay.
They were extremely surprised by the fact that we were able to approve them, and the thing is, we approved them with the bank that declined them.
That's funny.
We approved them with the bank
I'm
that
not
declined them.
surprised.
And the reason why this happened is simple. It's because many times when a client comes to you with their application, okay, there are things on their application, if you just take the numbers and punch them into a calculator, or if the client goes to an online calculator, they may not get a loan. It may show that they're declined, okay? But because Enza and myself sit down and understand the opportunities to help the client maybe shovel things around, pay down certain things, replace non-secured loans with secured loans, so that the numbers would fit in the lender's matrix, that is the way we work an application. So when the client came to us, we looked at their situation creatively and we said, okay, you know what, if you have a student loan here, maybe you should reduce the payments on your student loan. Okay, still pay it, of course, and make sure you do it on time, but go with a lower payment. You have this car lease here right now. Use this loan to pay off this car lease and get rid of that amount completely off your balance sheet. And that helped improve the numbers significantly. It helped them qualify with the same bank to buy their first property. So that was a client who was extremely surprised of what happened.
And we can also give you one other scenario where we talk about the business for self-individual, where the business for self-individual, she's a very artistic person and has a very successful business and came out of a divorce. And she's been renting for 1.5 years. She now came into her settlement and she went into her bank, and her bank told her that she would only qualify for a mortgage for $250,000. So when she was referred to us, because Joe, a lot of our business that we receive right now, we're getting a lot of referrals. The best business is the word of mouth business. You like our services, you tell 10 other people. If you don't like our services, you'll tell 50 other people, right? That's the strategy. But in this situation, what happened is the client called me and asked me if we could meet, and I definitely sat down and met with her. When I looked at her notice of assessment and I looked at her T1 general, I noticed that her gross income was high versus what she reports on her line 150 of her notice of assessment. So under the self-employed product, if you notice that the gross income is higher, we can use that gross income, and as long as you can confirm 2 years of that, that allows us to be able to qualify. If I tell you that she went out, and in Toronto, you cannot buy a house for $250,000, especially in the beach area, in the downtown. So she was able to qualify for a home for $700,000 and be able to get a mortgage for over $500,000. And she was ecstatic because the fact is that she can also use her home with a rental income a component and be able to generate more passive income from that. So it's all about sitting down with the client, listening to the client's need, positioning the client, and allowing the client to understand how you're positioning them. And that's why we work very good with our self-employed people.
And for real estate investors, since the chat is primarily focused on investors, we had clients who went and bought a rental property and got declined by their lender. They came to us, we were able to approve them. Why? Because we do deal with lenders that factor in, look at rental income in different ways. Some lenders factor in 50% of that rental income, some of them factor in higher, some of them factor 100%, okay? And also the way they use that rental income to offset the expenses on the property differs across lenders. Some say if you're renting a property for $1,450 a month and your expenses are $1,000, then your surplus is $450. That goes and gets added to your overall income, and some of them use it differently. So when you deal with one lender, the way they run the ratios and factor in that rental income is very likely to be very different from another lender. And that's why you may be declined with that lender, but when we take that application to the lender who we know is going to factor in majority of rental income and use an offset, what we call an offset method, your application will likely get approved. So it boils down again to the options available to brokers, as well as the ability to work with the client on creatively on paying down certain things and using alternative sources of funds to accomplish their goals, and fitting the numbers within the lender's guidelines.
And the beauty is that when you're working with one specific person, that person can gather all of your information and be able to put your information accurately on. That allows you to go to the first investment property, second investment, third, fourth, or fifth, until you can say then you're tapped up. But until you're positioned correctly, your investments become unlimited. You're able to do a lot, and that's the joys of working with us. And one thing that I wanted to add too is we've sat down with a lot of clients where some of the clients basically buy and want to be pre-approved and say to us, but my bank turned me down because they're telling me that I have to sell other investment properties in order to buy this investment property. So both Dahlia and I have sat down with the client. We go through a very financial detailed planning approach with the clients and understanding how many doors and how many opportunities they have. When we went to sit down and looked at their whole portfolio, they were actually positioned wrongly from the very beginning, and they had to go back now and go correct the step 1 to move forward to step 2 and step 3. So how did they do that? We told them, we don't take you away from your bank. If you are dealing with your bank, we'd like you to work with us on your investment moving forward in properties, but you can go back to your bank and correct that. So we kind of coached them one-on-one on how to position themselves to allow them to have more doors and be able to buy more real estate. And they were very grateful for that.
It's very good. We'll just take a break for a few minutes, and we're going to come back and continue the conversation. And we're back on the Cube Talk Show with Dalia and Enza, and we're talking about real estate investors and mortgages. Now, this is kind of a specific question, but it ties into everything. What are the options for a down payment if someone doesn't have one, or if it isn't large enough, or I know the holistic approach will probably account for that.
Mm-hmm.
Is that generally what you would say, or is there something specific that you would look for to say, you need to do this for the down payment, or you need to look at this thing to change?
It all depends on what the investor or the client is buying. If they're buying the guidelines for residential properties, which are 1 to 4 units, is that you need, which if it's a rental property, okay, a rental property, 1 to 4 units, you need 20% down, okay, minimum. If you're buying a property that it's going to be occupied by yourself and it's a primary residence or a second home, the rules are different. If you're buying your primary residence, you're looking anywhere between 0 down to, you can go 0 down, 5% down, up to 20% down. But keep in mind that if you go with anything than 20% on a primary residence, then you're looking for an insured product through CMHC or Genworth or GE. Commercials, Enza, you may want to cover commercials.
Commercial, which, as Dalia said, from 1 to 4, then you're looking at 4 and up. You're looking at different type of down payments, and you're looking at different structures. So when you look at a commercial, sometimes the lenders, commercial, anything 4 and over could be a multi-use property. It could be considered a storefront with apartment buildings. It could be industrial. So it's defining the specific use of the commercial is very important. So in that area there, the lenders are looking for a little bit more. They don't look at qualifying. They look at the cash flow streams, and they also look at how the risk tolerances of the specific location. Sometimes you're looking at anywhere between 30 to 35, but when you're looking at multi-residentials, you can go as low as 15% down. But that also kicks in with the insured product in that avenue. So as far as down payment it can come from your own source. It can come from 0 down, meaning that you can also have joint venture agreements with joint venture partners, or you can also do some equity takeout from your existing property. So we will help you on how to structure your deal accordingly to make the right piece fit in. So commercial is an avenue right now where a lot of people are getting into, and you can go as little as 15% down and as high as 30 to 35% in that avenue there.
Now, so on the same topic, rental income. Rental income, and I guess all the different types of it. You can have commercial as well, and residential and multi-residential. Anything that comes out as being unusual that you would find that people don't know, that you would tell them?
Well, we have a situation right now where we have a self-employed individual who has a commercial unit right now in a very high area, and he's got a good net flow coming in, which he has a surplus income. So having said that, that could be added income to his existing his existing income. So he can show that as extra income that will allow him for more growth potential and more mortgage potential, and to purchase a property that has a higher amount. So when we look at that, we have to look at the individual situation. So we can't categorize all the self-employed in one area and all the employed and salary or commissioned in a different area. We have to position each one as they are. So that's why we kind of put you in an area that we know that fits well, that will allow us to enhance more.
And also, Joe, on rental income, if you remember the example that we mentioned early on about how the different lenders factor that rental income, okay?
Yeah.
The way lenders look at rental income varies. And what I mean by that is it varies by what they factor, okay? How much they factor, how are they going to factor it, okay? And how do they look at rental income in general from a risk point of view? So when I talk about what they factor, if you're buying a property, and let's say you're buying a single family home and you're planning on renting the basement, that income coming from the basement will not be factored on your application, simply because that unit, unless it's legal, that income doesn't count. So if you're buying a property, the rental income that the lenders would typically factor is the rental income coming from legal suites, okay? So that's the what. The how they factor this rental income takes us to what I spoke about earlier, which is the offset versus the add-on method. If you have a property renting for $1,450 with expenses of $1,000, your net is $450. That $450 is used differently among lenders. Some lenders would add it on as extra income to the income you've reported on an application, and others use it differently. So that's called the offset versus the add-on method. And each has its pro and con. Now, how much do they factor of that rental income? Some may say this $1,450 we're going to take on completely, 100%. Some may say it's only 50%, and you've got the rest of the lenders between the 50 and the 100. Okay, so it is to the benefit of the investor that the application goes to the lenders who will help the investor get the most of that rental income in terms of qualifying. Okay, and finally, the risk. Some lenders add a premium to the rate if it's a rental property, and that premium could be between 20 to 25 basis points. While other lenders may not worry about that premium. Some lenders manage their risk on rental properties by reducing the amortization. So they're not offering 30 years, they may be offering 25 years, and others may be actually not going up to 80% loan to value. They can go 70, 75%. So everybody looks at rental income in different ways, and it boils down to what you're trying to accomplish and where are we taking the application. And in many times the client doesn't know all of these rules behind the scene, and they just take their application to the lender that they're familiar with without understanding what the lender guidelines are, and that, therefore they run a higher chance of getting a decline. If they get approved, great, but that's where the declines happen.
Yeah.
And some lenders will say, okay, we only have 2 sets of rules in renting. We'll either give you a variable rate or we'll give you a 5-year fix, but you can't get a 299 rate, or you can't get, because of like what Dalia said, it's about the risk related to the premium cost. So when a client goes into it, and we know that the client is going to buy and flip and not hold, we don't want to put you into a 5-year game plan where you're going to be charged full interest rate differential. So we would say to you, you know what, we know that the rate is higher based on the variable rates, because right now you're really not getting a appetite for variable rates. So we'll put you in a product that even if you need to get out of that product, it only will charge you the interest, 3-month interest versus full interest rate differential. Having said that, what Dalia talked about too is how we use the income based on that specific income. So if then you go to your second door, or you go to your third door, or your fourth door, your income is looked at differently, because then you're able to use that illegal basement rent to offset some of your other investment properties. But when we're specifically geared to lending on that specific property, we can only use the one income. If it is illegal, we can use the 2. If it's not illegal, we only use the market rent. Lenders now are looking at it totally different in guideline changes, because what happens is now is they'll ask for an appraisal, and they'll ask based on market rent. Before, we were able to say, okay, we can rent this house for $1,500. If the area warrants $1,500, they will use 15. But if the area is saying that we'll only rent for $1,000, we cannot use rent for $1,500. So lenders are getting more appetite to investors, so they need to understand more about what market rent is when we're doing some appraisal searching in that area.
So now, so what if you have a business, a corporation, and you're investing in real estate? Now, I think there's probably a lot of worms that are come out of that, but what's the first thing you'll look at versus the individual? What would be added on? I know there's a tax part to that, and there's probably a risk part in terms of the income, but where, how would you start that off?
So we're talking here about a corporation acquiring an investment property, correct?
Yeah.
Okay.
Well, what I had in mind was, say it's my corporation.
Yes.
Like I have me, and then I have my corporation.
Right, as
And
a
I'll-
self-employed,
And I'll use
yes.
my corporation to do the buying versus me.
Typically, the lender wants to see a property that doesn't have other operating income coming into it, and it's just there for the purpose of acquiring real estate. If you want
Okay.
to purchase a property under a corporation, so you can have your corporate, your business corporation, and then if you want to purchase a property under a corporation, you don't want your business corporation to go buy that property. You want to establish another corporation to go buy that property. But there are consequences or implications to buying under a corporation, and it's back to what are you buying. If you're buying a primary residence or a residential property between 1 to 4, well, first of all, primary residence, there is no need to buy it under a corporation. Investment property, 1 to 4 units, buying it under a corporation results in higher interest rate. Corporations will get a rate premium of 20 to 25 basis points extra compared to if you go as an individual and purchase a 1 to 4 unit. If you're purchasing a commercial, corps purchase commercial properties day in and day out. That's not a problem. Also, if on this side here, 1 to 4 units, if you're buying a corporation, today you're required to put 20% down on a rental property. So that's 80% loan to value. If the corporation is going out to purchase a 1 to 4 unit, that becomes smaller, the loan to value. Lenders offer 70, 75%. Some of them go 60, 65% on a corporation. So it limits your options if you're in that 1 to 4 category. But there are reasons to why clients go purchase under a corporation. So it all boils down to the cost and benefits involved.
And we also, when it comes to that situation where the clients ask us, do we incorporate or do we buy personally? We ask you to always get tax advice on it. Talk to your accountant or maybe talk to your lawyer. This is our viewpoint. This is our recommendation. But also at this point, don't take our recommendation seriously. We always ask you to take an opinion from from your accountant, because like Delia said, anything from 1 to 4, we recommend sometimes doing it under a personal, because you can always have an incorporation and kind of have an agreement between the personal to the corporation, because there's liability factors. But on a commercial, I strongly recommend any client buying a commercial property to buy it under a numbered company, or a numbered company or a corporation, because the liability factor is very important to do that. And also we recommend to seek advice on that.
And sort of another twist, partnerships. So 2 individuals come together and say, let's buy this piece of land, or let's buy this multiple unit. What's different about that? Is it just a matter of looking at the 2 people and seeing their profiles, or is there a combination factor that
it's like joining into a marriage, right? It's like you need to find the 2 people, and that they can be cohesively be compatible. A lot of people buy properties in their own names, and they have other people joint ventures, as we call joint venture partners, in there. There's an agreement that goes into play, which is, like we said, seek advice to see how it works. But there's also this avenue here where then the joint venture agreement is signed and people have a comfort zone between themselves in that way. Delia, I don't know if you want to add more to that.
Joe, it boils down again to understanding what the partners are trying to do, right? Each individual situation, and then we go about our recommendation on how we can structure the financing deal. Just as we speak right now, we do have a client, for example, who's looking to buy a $4 million commercial residential property mixed with her joint venture partners, and the joint venture partners are pitching in the money, and she's also putting money from her secured line of credit, but she is the expert on acquiring these properties, and she, through sweat equity, is going to improve it and as a result, yield returns for everybody. So the way we would structure this is we would suggest that on such a relatively complex deal, that the clients get together, form a corporation where someone is the officer, or one or more are the officers, and these are the clients with the strongest credit, with the better net worth, who will be providing the personal guarantees for the lender. And then the rest of the joint venture partners are shareholders. But then we take the deal to the lender and say, hey, Mr. Lender, here is the property, here are the officers, here are the personal guarantees. The money's coming from the shareholders of the corporation, but the client shouldn't go and establish a corporation and put the names on it as they see fit. It is very important that they have a discussion up front about what they're trying to do, what are they purchasing. So we look at everybody's financial situation, and we would make a recommendation as to how to best structure the deal.
And then when you get to a complex amount, like any amount, it's very important that we give the sound advice too. And as Delia pointed out, doing it this way structures the deal, makes everyone liable in a certain way, and it's all there in black and white. And it also makes it more attractable to the lender. So this is our way of selling the deal to the lender to make it more feasible and good rates with the client, with the lender.
Okay, I think we have a couple of minutes left. If people want to contact you or get more information, what would be the best way to do that?
They can, we have our 1-800 number. They can call us at our toll-free at 1-800-208-6255, or they can email us at info@streetwisemortgages.com, or they can contact us through our website at www.streetwisemortgages.com as well.
Okay.
Thank you.
It's very interesting. And so that's our show for today, the Cube Talk Show. It airs at 10 p.m. Weekdays. It'll be about a week's time though, and you could see it on YouTube, ThatChannel.com, and on my website, www.joetheinvestor.ca. To contact me, my email address is joetheinvestor.today@gmail.com. And have a good evening. Thanks for watching.
Thank you.
Thank you.
Thank you very
you.
much, Joe.
Thanks, Joe.
Joe, thank you.